My research area is technical analysis. We'll start with a basic introduction to technical analysis, then move on to what my research idea is, and finally we'll look at what I've been doing thus far. So technical analysis simply looks at using past price and volume data in order to predict future market trends. Now it's based on two principles which were first suggested by Charles Dow. The two principles state that prices move in trends and that trends are repetitive over time. But the success of technical analysis hinges on the slow movement of the market. Now here we have a small, very simplified diagram. We've got the price on the y-axis and the time on the x-axis. Now if we have a price series that is moving at its old equilibrium price, new information starts entering the market. Now what we initially taught by random walk hypothesis and the efficient market hypothesis is that the jump to the new price is instant. However, what technical analysis will teach you, or will state, is that that shift is not instant, and we can gauge that direction and take appropriate action in order to benefit from market trends. Now I just mentioned what the random walk hypothesis and the EMH. Now what the random walk hypothesis tells us is that there is no serial correlation within price series. So that means price movements are independent and therefore there should be no trending nature of prices. Now one actual fact that's put forward, not a fact but a hypothesis that the random walk puts forward, is that the information entry in the market is unsystematic. Now if the entry of information is unsystematic, there should be an unsystematic outcome. So there's a 50% chance of an increase or 50% chance of a decrease in the price levels. The efficient market hypothesis, which states that all information is fully and fairly reflected in the prices, puts forward three schools of thought. Now, the main focus of a technical analyst is on the weak form, because the weak form directly contradicts technical analysis by stating that past price and volume data is already reflected in the price. Therefore, it's pointless to use technical analysis to try and beat the market or try and predict trends. Now, one of the great critiques of technical analysis is Robert Malkiel. If you have had the opportunity to read his book, A Random Walk Down Wall Street, you'll see that page after page he has this attack against the technical analysts. First thing he states is that technical analysis is a game of luck, and that he would place technical analysis on a pedestal alongside alchemy. He also states in an example that a technical analyst is like a man sitting in a field observing a pole that is tied to a pig, and he's trying to predict what direction the pole is going to move in, without even having the knowledge that it's a pig in the first place. But then one of his very famous quotes was that a chimpanzee throwing darts at the Wall Street Journal is able to pick a portfolio better than what an expert will. But with every detractor there comes support for technical analysis as well. We'll start with Hogan, 1995. In his book, The New Finance, Hogan states that market efficiency is a fantasy, and that a fantasy is usually gross distortions of reality. Now, in order to support his point of view, he brings forward anomalies. He talks about, for instance, momentum from overreactions, and then the subsequent reversals that Devont and Taylor had put forward. And then he also cites Jagadish and Titman's study, which states that momentum in the short term, so past 12 months winners will continue to do well and losers will continue to do poorly, which automatically means that there will be trending nature of stock prices. In support of technical analysts, we've also got the concept of autocorrelation or serial correlation I mentioned earlier. Now, random walk will tell you that there is no autocorrelation or serial correlation within a price series. However, here we have the S&P 500 autocorrelation graph. This is something we had a look at when Gary presented earlier. Now we have positive autocorrelation and negative autocorrelation. Autocorrelation simply looks at the dependencies within a data set. So if random walk was true, there should have been no dependencies at all. However, we see that in this case we see that there is positive as well as negative serial correlation. So does that tell us that prices can be predicted? the behaviorists provide further support for technical analysis. Now, behavioral finance tells us that investors are irrational. And they put forward quite a few biases to provide support. The first one we look at is the conservatism bias. Now, conservatism tells us that the market will initially react slowly to information. And that is because investors are fearful, or their personal emotions guide them towards, like say, if you know something, you want to believe that that's right, and not anything new is trying to influence what your core belief is. Secondly, we have the noisy rational expectations theories. Quite a long term, but all it means is that, all it says is that the new information is not instantly reflected in the stock price. And that is mainly due to information asymmetry. That is, some people having more information, and secondly, the cost of information. Now, say Professor Shea here is, well, he must be having quite a few subscriptions with different news feeds, and all that information comes to him every morning. He can read it and act on it. Whereas us who are on the public sites, we might not get that information, so we might wait, or we might take longer to react. Similarly, what might happen, we see him trading on a stock and we're like, wow, he knows what he's doing. Let's just join him, and that's how herding comes about. Which also drives prices in a particular direction, and then prices trend, which is exactly what technical analysts are looking for. And lastly, we have long market memory. Now, long market memory is a decaying effect that a past event will have on a future outcome. So if, say, like in the case of herding, if the market is pushed in one direction, what long market memory says is the irrationality of investors will drive them to continue pushing that stock in a particular direction, basically forming a bubble. And yeah, it leads to repetitive and non-periodic but cyclical patterns that we can use technical analysis to identify. Now, my research idea is global equity sector investing, sector rotation, and tactical sector allocation using a technical approach. Now, technical analysis is made up of two fields. You've got the quantitative technical analysis, and you've got the charting-based technical analysis. Now, quantitative analysis will involve, for instance, your moving averages, exponential moving averages, your relative strength. Whereas charting will involve directly determining trigger points or buy and sell signals from the chart or the patterns. So my focus is on charting, and the approach that we will use is the technical charting heuristics approach and the template matching technique. Now, the template matching technique is simply a device or a technique that is used in photographic image recognition, and it identifies certain patterns and then gives off a signal. I've got two patterns, well, it's one pattern, but you've got the reversal, they're both reversal patterns. You've got the saucer and the rounding tops pattern. Now, the saucer should allow you to identify the market trough and buy the stock at the bottom of the cycle, and the rounding tops allows you to purchase, to sell the stock at the top or at the peak, market peak. Now, in order to use these price windows, you can see the shape is denoted by the gray areas, and the linear function that is used will reduce the weights away from the core function, thereby allowing you to only it only gives off a buy signal when the exact pattern is met. Now, that is ensured by using trading rules. The trading rule has fit and height variables. The fit variable entails basically the actual pattern fit, and the height is whether there is enough volume within that trade for the trade to go through. And a counter trend trading system is implemented to ensure that you buy when the stock is trading below its long-term average, and it's sold when trading above its long-term average. Now, I'll get back to that, of why we exactly bring that in. Sector rotation is one of my areas of focus, or I would like to do it. Sectors, the basic principle behind it is sectors are not perfectly correlated, and sectors are in favor at different points of the cycle. I've got this little graphic to help us out here. We've got the economic cycle, we've got the market top, bear markets, market bottom, and the bull market. And then we've got the 10 sectors as per the global industry classification system, which shows, okay, this is a perfect world scenario. So we said the market top, the energy sector is in favor, as we're moving down, consumer staples are resilient in the bear market. As we start getting to the bottom, consumer discretionary and so on. The different sectors perform differently at different points of the cycle. Second, we have this global technical sector allocation, the GTSA. Now, technical asset and style allocation has widely been studied in empirical literature. What the GTSA or the global technical asset allocation model entails is assigning a set percentage of your portfolio to a particular sector or an asset class, for instance, and then subsequently determining whether to remain invested or shift out and go into cash. Now, the reason why, or the rationale behind it, is to enjoy the boom markets and avoid the bear markets and try and minimize drawdown. So my focus is on a global market, but why global markets? Mainly because when we're looking at sector-specific investing, we have country-specific risks. Now these risks are likely to affect all the sectors. For instance, if there's an election in South Africa and there's political instability, regardless of which sector you're in, you're likely to have a dip in that sector if the instability is quite high. However, which leads to correlation between these sectors. However, if you look at a global market, country-specific risks, which are systematic at a country level, become diversifiable at a global level. And therefore, there is less sector correlation. Now, the key contribution of what's different in what I'm doing is, well, we're still looking at a risk management tool. Now, GTSA model that will employ technical analysis, and frankly speaking, it's from the literature that I have consulted, this will be the first application of a charting-based model away from a single index. So we're moving towards indexes and applying a GTSA model using charting. And this is a very nice, well, if this was a finding, this would be a great finding to have for any research, is to earn equity-like returns with bond-like volatility. It's something that Faber 2007 found with his model. And his was also a global, his was a technical asset allocation model, which allocated the portfolio between different asset classes. And so what have I been doing in 2015? The past 2 weeks I've spent on acquiring data, and I have chosen the Standard & Poor's 1200 Global Index. I've acquired daily prices and volume data from Bloomberg databases, and the daily open, high and low from EconStats. The daily 3-month treasury bill data, I got that from the US Federal Reserve economic data, and I have, apart from the daily 3-month T-bill data, everything else was in the same format, so that was fine, and everything was in US dollars. The 3-month T-bill data had to be standardized and put in the same format, especially in terms of dates. So all that's been done. Now, the selected equity index and why I selected the S&P 1200 Global Index. The inception of the index was in 1999. The index has 1,202 stocks from 30 different countries. It's both developed and emerging countries. And the index is a composite of 7 headline indices. So we've got S&P 500, S&P Canada, Latin America, Japan, Asia, Australia, and 3 of Europe's indices as well. Now, I've selected the S&P 1200 mainly because it is used as a benchmark for global equity portfolio investing. It has very good liquidity, very high liquidity, which is very important when you're taking into consideration technical analysis, because technical analysis will develop buy and sell signals in certain cases quite often, so you need the liquidity to be able to trade. So practical implication, liquidity is important. Investability is also important. If you want to easily invest in the index or in any of its sectors, there are ETFs available. It's also denominated in US dollars, which makes computation fairly less complicated. And there's a broad market representation. The index constitutes 70% of global market capitalization. Another important factor about the S&P 1200 Global Index is that it's got standardized sector, region, and market representation. So most important for this study is the fact that there is standardized sector representation. It uses the JIC system, which is a global industry classification system developed by MSCI. And what we have is 10 different sectors, and each sector index has readily available information. Now, as you'll see, the different sectors have different sizes. The financials is the largest, utilities is the smallest. We'll get back to that later on in the presentation. This graph is just a basic line graph of all the data that I've collected so far. It's very crowded, but the reason why I've put it up is just to show you like the certain points where you find uncorrelated sectors. Like here we have the energy sector coming, it's going downwards, but we'll have the consumer staples as well as the information technology experiencing gains at that point in time. Here now we'll basically look at the simple or potential problems that I could face and the preemptive solutions to those problems. Now, last week when we had the presentations, we discussed the adaptive market hypothesis. Markets learn over time, and that's what we made clear last week. Now, if a market learns over time, if you have a pattern that you're using in 2000, if the market's going to learn that pattern, it might not apply in 2008. Now, a possible solution to that is to use adaptive price windows. That is, now it's very important that you avoid data mining as well. So what we can do is use, like say if you're computing the 2000, if you're in 2005, use the best fit window from 2004, and as the time goes on, it adapts to the next year as well. And then with technical analysis, excessive trading is a big problem. It leads to excessive trading costs as well. Now, two ways to address that is to condition the trading rules to have high thresholds, and secondly, to use an exponential moving average filter to ensure counter-trend trading that we had mentioned earlier. Third problem that we could have is the appropriate benchmark. Now, that's mainly because the different sectors do not have equal number of constituents. As you can see, the financials has the most constituents and utilities has the least. In order to address this problem, we will create an equally weighted benchmark index and then use a buy and hold strategy as the benchmark. And then we have the trading cost, which has to be accounted for if we look at practical application, in which case we'll use a percentage trading cost. And then lastly, we have the problem of effect of buying runs. If you look at a window that fits today, by using daily data, it is very likely that that same window will fit tomorrow and the next day and the next day. Now, in order to avoid such an occurrence, we only take note of the first signal that is generated and discard any subsequent signals thereafter. Thank you.
Very good start. Okay, to some questions. A very minor problem. I don't know if you really noticed some of the reference, like Jacobian settlement, the year reference were not really there. Yeah. I think it's just omitted. Can I ask you? I mean, when you do technical analysis, compared to most of people doing style analysis, market anomalies, and so on, there are company fundamentals backing up in order to interpret the results. How do you, I know you did a dissertation on the same topic as well, of the pattern fitting and all that, but how do you intend to interpret your results if you have, basically technical analysis